Hello friends, a very warm welcome to my channel. In today's video we are going to do the analysis of Marshall Machines, which is another microcap company. This company is into manufacturing of CNC machine and other machine tool equipments, which is a proxy to the Capex theme in India. Before we talk about this company in today's video, I want to discuss a couple of things. First thing is, whenever we are analyzing microcap companies, you have to be very careful whether investing in microcap companies is suitable to your risk profile as an investor or not. These days we are discussing more about the microcap and the small cap companies because the large cap companies are already known to you, and it doesn't make much sense for me to talk about them as you don't need much help from my side in that. So when you are investing in microcap companies, you have to be very careful that you closely monitor the developments in the companies and you enter and exit with a particular strategy. Unless you are well versed with this kind of investing, it is better for you to stay away from such size of companies. The second thing is, whenever we are making any video, the purpose of the video is to identify some good companies or identify some interesting companies, whether good or bad, and bring forward to you the information whatever is available on the internet about those companies, and also share my experience about that industry and how to look at that company from my point of view. The investment decision is yours, whether you like it or not. You have to listen to the video entirely and take an investment call on your own. So the purpose of the video is not to give you recommendations, because I keep creating videos every week, so not all the companies discussed in the videos are worth buying. So you have to take a wise decision whether the company is invest worthy company based on the analysis which we do in the videos. If you are still not a subscriber to the channel, please do subscribe, and if you like the video, share with your friends, and if you are not a part of a Telegram channel, do join today as we discuss daily market analysis, and lot of interesting news and views are discussed in the Telegram channel as well. So now let's get started. Marshall Machines is a company into this CNC manufacturing segment. Earlier they were into other ancillary products related to machines, and this is the second or third generation which is into this business, and they are into this business for more than 60 years now. So this is a newly listed company, but in business as such they are not new. They already have 7 patents which they have registered and applied for 22 patents. They have executed more than 120 projects and they have supplied more than 4,000 machines until now. So they understand this industry and these products pretty well, and they are a research driven innovative company. In their portfolio of products, they offer 35 different SKUs of machines which they manufacture, and they also customize the machines as per the customer's needs and offer them. Mr. Gaurav Sarup is the co-founder and managing director of the company. His studies are also in this domain. He has done production engineering from Punjab Engineering College, and he has more than 35 years of experience in this domain. He is a third generation promoter, as we have discussed. His father and grandfather were also into the same business, and he handles the entire strategy and management of the company. Briefly, let's discuss the history of the company. They started in 1961. Mr. Gautam Sarup, who was the founder of this business, the original founder, and second generations joined this business in 1986. In 1997, they did a international collaboration with a company called Path Wizard, which is of USA, and after that they started manufacturing the CNC machines in their first unit in Ludhiana. Prior to that, they were manufacturing other machine components. In 2002, they launched their first double spindle patented product, and in 2009, they launched their fourth spindle CNC machine. In 2012, they inaugurated the second unit which provided turnkey automation solutions, and 2014, the third generation also joined the same business. Throughout this journey of the last couple of decades, after they started manufacturing the CNC machines, they have been constantly innovating, and the type of machines which they manufacture have improved. The technology has improved, and the variety of machines which they manufacture has also improved, and they now cater to various industries. Recently, what they have done is they have also made their machines as per the industry 4.0 standards, and they are also focusing on the Internet of Things enablement in their machines. In 2018, they got their company listed on the NSE SME segment, so it has a very less history in terms of a listed company. In 2019, they launched their SmartFac Universal Factory Monitoring System. In 2019, they started their technical center in US, and by 2021, they have done a huge Capex in the last 2-3 years, and post this Capex, the revenue potential of the company has gone up to 250 crores. Now let's come to the business analysis of the company. Basically, the company is focusing on complete turning solutions to boost the productivity, reduce the cost per component for their customers. So what this company basically focus on, there are a couple of words in this which you have to focus on, is the boost productivity. So whatever the company, whatever their customers are already manufacturing, The company aims that by using their machinery, their customers can either go for automation of their processes, or if their processes are already automated, by using their machines they can increase the efficiencies of production. By that they will increase the output and reduce the cost. So this is the main aim of the company when they are manufacturing products and customizing for their customers. Few of the products which the company manufactures we will discuss on the screen: linear tooling solutions, smart load solutions, then intelligent solutions with clap and clamp. We will not get into the technical details of each model which they manufacture, just for an idea we'll get a feel of what the products the company does. Then solution for chucking components like linear tooling machines. Now these are the spindle machines which we were talking about, single, double and 4 spindle machines. So as you see on the screen, you can understand that manufacturing these kind of machines is not just like a commodity business which easily can be manufactured. This requires a lot of technical knowledge, know-how, and also the technology has to be upgraded every year to match the industry standards. So the company has 2 manufacturing units. The first one was started in 2001. That has a capacity of manufacturing 600 machines, and the second unit was started in 2012, and this has a capacity to manufacture 100 to 125 Roboturn automated machines, 150 compact CNC machines, and 1500 smart correct gauging stations. Now in terms of clients, you see, as of now the company has been catering to 3 industries: the automobile industry, the consumer appliances and durable industry, and the general engineering industry. Now the company wants to diversify their focus and work towards industrial sectors like defense, aerospace, and also the electronic and medical equipments. Up till now the company has worked with more than 1500 different clients. We'll discuss about the names of the clients going further, and broadly their customers can be classified into 2: the large corporates as well as the small and medium enterprises. More than 400 clients are 10-year-old, so they have this kind of old relationships with their clients, which gives them repeat business. These are the companies which they have already worked for. You can see all the popular names in this, like Bajaj, Kalyani, Endurance. Then you have JBM Auto, Uno Minda, Rico Auto. So all these kind of companies have been working with them in the auto sector. In the consumer appliances and durables, they have worked with ABB, Bajaj, Bosch, Havells, Orient Electric, Siemens, Polycab. So again, there are very popular names in this. In the general engineering business, they have worked with PSUs also like BHEL, GMM Pfaudler, Honeywell. So multinational companies are also their clients. So this kind of clientele gives us confidence that the product which the company is manufacturing is of international standard. Now industry wise, if you see the revenue breakup, only 55% of their business comes from the automobile industry, 25% from the consumer appliances. General engineering contributes about 19%. Going further, this ratio will change as they will focus on the new segments like the defense, aerospace, electrical components. Now let's talk about the industry in which this company operates. When you look at the entire globe, China contributes about 30% of the business in this industry, as a lot of manufacturing activity happens in China. Then India constitutes only 3.5%. So compared to China, when Make in India initiatives pick up pace in India, you can imagine the amount of the extent of demand which will create in India compared to China, as this business will shift in India. Europe accounts for 30% and America accounts for 18%. As of now, although the share is just 3.5%, still India as a country is the 7th largest consumer of the machine tool equipments in the world and 12th largest machine tool producer globally. Soon these kind of positions will change and Indian market will grow in size. This market is highly fragmentized. There are few big brands which work in this and lot of unorganized players who also manufacture these. So there are more than 1000 supply chain units which are working in this industry, and as a country, if you see, India, although they manufacture the machine tool components, but still looking at the demand in India, still India is a net importer of this. So still we import these machine tools or equipments from other countries of the world. So this is an emerging sector. A lot of industries need this kind of machine tools equipments for their manufacturing, and it is a growing sector. There is an import substitution opportunity here because India is a net importer. So when good quality machines are available in India, people would prefer to buy from India, as we get the service support in India, as there is no freight cost or custom duties if you buy the Make in India components. The existing companies, where they will start going for mechanization as labor is difficult to find and becoming expensive. So they will start automating their processes, which will increase the demand for these products. And the government initiatives like Make in India, Atmanirbhar Bharat, Make for the World, these kind of things will also increase the Capex in India, which so this company's investment as an investor for you is an ancillary play to the Capex in India. When we talk about the competitors of the company, there are two broad segments in which I divide the competitors, or I would divide in three broad segments. The first one is this company competes with the international companies where the people from India, they import globally manufactured machines like the German machines, Chinese machines. The second category of competition comes from other branded players in India like Lakshmi Machine Works, Mac Power, Lokesh Machines and several other brands which are in the unlisted space also. The third kind of competition comes from people who are unbranded and unorganized players where the quality of the machine is lesser, but still there are small industries who prefer to buy cheaper quality machines and sustain with them. So there will be intense competition for this company, and the customers also will be very keen as they will prefer to buy machines from the good or the topmost companies, as the production should be very precise and accurate whenever they use their machines. Now, what is the competitive edge if there is so much competition in this space? The company is into this business for more than 60 years, so they will definitely have that technical competence, they will have that experience and relationships with their customers. They have good world-class manufacturing facilities and they have done Capex recently. They have 7 patents already, applied for 22 patents. They are upgrading their machine models every year in respect of the latest technologies like Industry 4.0, Internet of Things, and they also focus more on the affordable automation for their customers so that the customers can reduce their costs and increase their profits. What is the growth outlook of the company? The most important thing is the company has done Capex in the last 3 years, which has increased the revenue potential to up to 250 crores for them. They are also open to strategic alliances with foreign companies where the foreign companies can provide technical know-how and they in India can manufacture better quality machines. Want to reduce their working capital cycle? Now, why we are talking about the working capital cycle, you will understand better when we discuss the financials. And they are also focusing on deleveraging because the company has high debt. Geographically, the company wants to scale up their business in India, and they also want to look at global markets as they look for other partners in other countries to distribute their products. In terms of margins, they want to scale up their margins to up to 25%. Practically, whether the company will be able to do or not, that we have to closely monitor. In terms of order book, FY 2021 it was about 51 crores. Now it has gone up to about 54 crores. And the bids which the company does is 135 crores, which has gone up to 260 crores. I wouldn't give much importance to the bidding as they may or may not get materialized into fixed orders. In terms of risk, the company is presently dependent on a couple of sectors like the automobile sector, and automobile sector is cyclical in nature. So in turn, the business of this company also becomes cyclical. So their dependency on a couple of sectors poses a risk, as if there is a constant slowdown in those couple of sectors for a long period of time, the business of this company will also become stagnant. As in the automobile industry, people move from normal cars to the EV vehicles, there may be the number of machine components also may go down, so the demand for this kind of machines specifically in the auto sector may be a little impacted. This is a Capex theme kind of a ancillary industry, so overall if the economy does well, this kind of companies get more business. If there is an economic slowdown, the business from these companies gets reduced. The company has to focus on upgrading their machines every year, otherwise the people will prefer buying machines from the topmost companies in India or even global brands. The commodity prices impact the raw materials of this industry, and this company may or may not be able to pass on the inflated cost to their customers fully, which will impact the margins. In terms of risk, we have clearly discussed that this is a highly competitive industry and people prefer the top brands for buying their machines. Now coming to the financial analysis, after understanding the business completely, the last 5 years the revenues have been flattish, there is not much growth. The revenue has been between 50 to 60 crore. In terms of EBITDA, the EBITDA, there we don't see a steady growth. In fact, we see a decline in the last couple of years. EBITDA has gone down from the 15 crores range to about 7 to 9 crores. The EBITDA margins also followed the same. They went down to about just 10 to 14 crores. So we have to closely see going further what are the sustainable EBITDA margins for this company. The net profit level, the company entered into losses. They made almost negligible profits in FY21 and they made a loss of 3 crores in FY22. After the IPO, the share capital of the company increased to 14.5 crores and it remains the same thereafter. The reserves have steadily grown. It has a small dip because of the recent loss in FY22. In terms of borrowings, they have steadily increased, which is not good. This is one way okay because they have done Capex, but look, going further, now they have sufficient capacity, so they should look at reducing the debt so that their margins increase. Presently, the company has a debt equity ratio of 0.87, which is slightly on the higher side. Trade payables are also slightly on the higher side. We'll discuss the working capital ratios going forward. Fixed assets have steadily gone up from 20 crores to about 60-70 crores because the company has done Capex in the last 2-3 years. Inventory levels have steadily increased, which is not very good because the revenues have not started, because the revenues are not going up, so they are piling up inventory, which is not a good working capital management sign. Inventory days are very high. They are doing about 400 to 500 days of inventory. One reason for this could be because they maintain a lot of SKUs for different components which they assemble and manufacture these machines. But still, even though we consider that fact, but having 400 to 500 days as inventory days is very much on the higher side. In terms of trade receivables, they have gone up to about 18 crores. So when there's no increase in the revenues of the company, trade receivables going up is also bad working capital management. Debtor days are almost above 100 days now, which is not a good sign as they are getting money slower than before. Cash position is not so well. They almost have negligible cash on their balance sheet. And operating cash flow has not been that impressive, but it has always remained positive, so there are no red flags. In terms of free cash flow, they are not generating much of free cash flow because they are spending on Capex, but going further, we have to ensure that the company generates free cash flow and also reduces the debt. ROCE has gone down because the company's profits and the margins have reduced. Overall, you understand that the company is not doing very well in terms of fundamentals, in terms of revenue growth, margins, or generating cash flows. They have high debt and the working capital management is not in good shape. The promoters hold about 60% in the company and public holds about 40%. The promoters holding has declined recently, which is also not good. They have gone down from about 73% to 60%. In terms of valuations, the market cap is just about 40 crores. So it is a microcap company, which is highly risky for investment. Revenue is about 60 crores. So in terms of market cap to revenue, the valuations look very attractive. But these valuations are low because the company's performance has not been good in the past. Margins are less, just about 11% EBITDA, ROC and the ROE is very less because the company incurred losses recently. In terms of price to book ratio, it trades at 0.91, which is again looking cheaper, but the performance of the company has not been good. Now, if the performance have not been good, then what is the use of investing in such companies? The company has done Capex recently, so there is a hope that the company will utilize those additional capacities and perform better. That could be one of the rationales of investing in the company. The auditors of the company are Messrs. Sood and Co. The auditor's remuneration is 35 lakhs, which I felt is slightly on the higher side for this size of a company. ROE remains low because the margins and profitability is low. The company doesn't pay dividend because they don't have enough cash flows. Director's remuneration is somewhere around 8 crores, which I feel is very high for a company of this size. In terms of contingent liabilities, there are a lot of contingent liabilities listed in the annual report. They have some issues going on with their past vendors, so for all those things there are some cases going on. I've also observed that some of the loans which the company has taken is at very high interest rates, which is ranging from about 14 to 25%, which I feel is very high for any business to generate better ROCEs compared to these. And when I look at their debtors, out of the 18 crore debtors, 4 crore debtors are more than 3 years old, which brings question to my mind with respect to recovery of those debtors. These are some things which I wanted to highlight, which you should know as investors before you choose to invest in this company. When you look at the chart is very weak. Post listing, the share price went down and it is still consolidating from those levels and presently trading somewhere around 30 rupees. So market is also not giving much value to the stock because the market doubts the company's performance. So only when the performance is shown consistently by the company, there could be a improvement in the share price of the company. So this is about Marshall Machines. Let's discuss in summary the thesis and antithesis points. The company has done very good Capex and increased the capacities to about 250 crores of potential revenue. So there is hope that the company may do well going further. In terms of the sector in which the company operates, it is a good sunrise sector as the company, as the government is encouraging Make in India initiative. So there will be huge potential in this sector as such. So the opportunity size is huge. The company knows what their weak points are. They are focusing on deleveraging going forward. They will focus on consistent growth and they will also focus on improving their margins and ROCs. But when these kind of things are actually happening, we should be more interested as investors in this company. Another advantage is the management has been into this business for last 60 years, so they know the intricacies of running this business. In terms of antithesis points, the margins are inconsistent, so we don't know clearly what is the normal margins at which this company can operate. The company incurred a loss in FY22, which makes us more suspicious. There is execution risk because they've already done Capex, but we don't know whether they will actually be able to execute their growth plan successfully or not. In terms of competition, there is stiff competition from both organized and unorganized sector as well as the global players. The company is managing their working capital badly, so there is liquidity risk in the company. And in terms of growth, in the last 5 years, the company has not shown any kind of a growth and the revenues are flattish. So this is about Marshall Machines. I hope you like the analysis, which is totally unbiased, and I'm sure you will be able to take the right decision after watching this video. If you like it, hit the like button and subscribe to the channel. Share with your friends. And if you are not a part of our Telegram channel, do join today and let's stay in touch. Thank you for watching. And if you want me to make videos on your favorite companies, don't forget to mention that company's name in the comments. Thank you for watching and have a wonderful day.